Hello again. Welcome to another episode of the Uranium Market Minute. Today is Wednesday, June 22nd, and this is episode number 140. My name is Justin Huhn. I am your host. I'm the founder and publisher of the Uranium Insider Pro Newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. As always, nothing in this podcast that you see or hear is intended to be investing advice. I'm not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing, and always take responsibility for your own choices. All right, good to be back with you guys again. It's been a few days. The last podcast was last Friday. Then we had a long weekend with a market holiday on Monday. And yesterday we had our members only webinar for the month of June. That was an excellent session that we had. Again, it was a 2 hours deep session. Our guest had to cancel on us, but that gave us a little bit more time to take our time through the thesis and answer as many questions as we could with our members. So if you are a member and you weren't able to join us yesterday, the replay is up on the website. You can stream that at any time. It's right at the very top of the members area of the website after you log in. If you are not a member and you're interested in seeing the type of content we put out, you can click the link in the description below and get a free sample of a previous month's newsletter. A little bit of housekeeping. I wanted to say thank you so much for the congrats that we got for 15,000 subscribers. This channel continues to grow despite the let's be a little bit generous and call it unfavorable market conditions that we've had over the past few months, and really especially over the past month and 6 weeks. It's been pretty nasty out there with a couple of counter trend rallies. Had a small rally yesterday, gave pretty much all of that up today. Uranium stocks just pretty weak today, even with the broad market basically flat on the day after seeing a slight bounce after Powell spoke this morning. But I want to get into a couple of elements of investor psychology and some interesting things that I'm seeing in the market in the mailbag section. Before we do that, why don't we go ahead and jump into the daily scoreboard. Spot price of uranium sitting at $47.50 a pound mid-market. That's about a $2 a pound bounce that we saw yesterday. Nice little bounce towards the end of the day yesterday. The spot did not buy any pounds yesterday. Interestingly enough, we do have some other players there in the spot market. Typically, we've seen these up moves in the spot market when spot is not buying, when there are flows coming into the spot vehicle. And we see traders seemingly trying to front run the expectation of more buying by spot. Now, spot is sitting on $70 million in cash. So technically they can buy a little bit more uranium here. But I did find it interesting to see the market. Well, I guess the market was moving up a little bit yesterday, but to see a $2 up move in the spot price of uranium with spot not buying and still trading at a big discount to NAV. In fact, spot closed at an 8.62% discount to NAV yesterday. The total NAV of spot sitting at 2.74 billion. Like I said, they've got 70.6 million in the treasury. Turning to the ETFs, URA reported redemptions equal to 520,000 shares. No change in outstanding shares for URNM. That redemption from URA led to 6.8 million in mandated selling. That likely was in one of the higher volume selling days of last week that just reported yesterday. So now we're sitting at, let's see, the joint AUM, the assets under management for URA and URNM, now sitting at 2.2 billion, an astonishing decline of over 1.2 billion from its recent mid-April high of over 3.4 billion. So mid-April, we were back at pretty much all-time highs in the AUM between URA and URNM, and we've sold off substantially since that high. That's a really big move, honestly. In today's action, the uranium shares did trade relatively poorly. So why don't we go ahead and look at the charts. URA down just over 4% on the day. Not huge volume of selling here, but definitely an underperformance of the S&P. In fact, why don't we look at URA relative to the S&P? Big down day for that, for URA relative to the S&P, but we are still within that uptrend line for URA. We lost that trend line in URNM. But very interesting to see us trading back down towards that trend line. Will it hold this time? That's a big question in my mind. And honestly, I do not have the answer to that. Risk is still off. That's just where we're at, folks, right now. Let's look at Cameco. Cameco has been, generally speaking, a leader of the pack, especially since the Russia invasion of Ukraine. It's generally assumed that they will be one of the main beneficiaries of geopolitical realignment and a shift of Western utilities purchasing from Western suppliers. And so Cameco today down 3.33%. We did see it's printing a bit of a hammer today, closed near the highs of the day, which is a good sign. Volume still pretty low, so clearly not a rush of money coming after this, but it's good to see some dip buying happen in Cameco. Sprott Physical Uranium Trust down 3% on the day, and with the spot price flat since yesterday. So the up moves happened yesterday, but I didn't do a UMM yesterday, so reported on that today. But with the spot price flat and SPUT back down 3%, we're probably close to an 10 to 11% discount to NAV here, which is historically very, very large. I would not be surprised to see some speculation come in here. I am noticing in a lot of the uranium stocks, and this one is no exception, we are seeing some positive divergence in the relative strength. A lower low on the actual stock and a higher low on the relative strength. Typically that can mark some form of a bottom, at least a short-term bottom for the stock. And we're seeing that across the sector. Okay, mailbag section. So a couple of things I wanted to note here. I wanted to talk briefly about inflation and how that is potentially going to affect the cost bases for development projects and producing projects and exploration projects. I mean, across the mining space, across any industry, really, we're seeing input costs drastically rise. A lot of that has to do with rising costs of fuel, rising costs of diesel, primarily for mining operations. But we're also seeing, for example, for ISR mining in Kazakhstan, we've seen a 50% price increase on the cost of sulfuric acid. That's the lixiviant that they use to inject and extract from the ore body to pull the uranium out of the ore body, out of the aquifer. And the cost, that's a major expense for Kazatomprom and their JVs. And that is up 50%. I believe that's a year-over-year number. That's just one example. We're hearing from companies, other ISR companies that are working on developing ISR mines that are having a hard time finding the PVC pipe to case the wells, the drill wells for the ISR mines. So across industry, across asset classes, across materials classes, everything is A, difficult to get your hands on, and B, more expensive if you're lucky enough to even get your hands on it. This is just the reality that we're in right now. We're seeing labor shortages. And we're seeing just big inflation across the world and across industry. So what does that mean for uranium stocks? What does that mean for future uranium production? So essentially, what we talk about frequently is incentive price to bring in new production. Okay, so we have the existing producers. Obviously, they're producing at a profit. We have, CGN producing from a JV in Kazakhstan, producing from the Huhn mine. That's 8 to 9 million pounds a year. In Namibia, that's a very big mine. That was a huge capex for them. They've got an all-in sustaining cost somewhere around $50. That's probably closer to $60 right now. CGN also recently just signed that contract for delivery 2023 to 2025 at fixed 40% fixed of $61.78, if I recall correctly, almost $62 a pound fixed. With 60% of the contract set to reference to the market. So the spot price at the time of delivery is what the buyer will pay for that uranium. So now you can see if CGN, their primary production coming from the Huhn mine with an all-in sustaining cost somewhere, I mean, this used to be in 2019, probably around $45 to $50 a pound. That's obviously, we're in a very, very different world in 2019. So it's probably pushing 55 to 60, if not more. So honestly, surprised they didn't lock in more profit on the fixed portion of that contract. They did have an inflation multiplier that will apply to 2024 and 2025's delivery. But with 60% of the contract reference to the spot price, and when you have entities such as TradeTech, one of the primary nuclear fuel consultants, saying we could see prices above $100 a pound in the spot market next year. Yes, you heard that correctly. So clearly CGN has exposure to that, which would lock in a lot of profit if those pounds are coming from Huhn. If they're coming from Kazakhstan, obviously they got a much lower production cost profile coming from a JV in Kazakhstan. That's probably in the 30s all in. So either way, so this incentive price, so those are the existing producers, right? Those are the costs. CGN, Kazakhstan, Kazatomprom, and all of their JVs in Kazakhstan that are producing uranium-1, Orano, a number of other Chinese entities. You have Cameco producing not only with their Inkai mine, their JV in Kazakhstan, but of course Cigar Lake, and they are working on getting McArthur River back into production. And there's a little bit of production happening from the States. There's some production coming out of Australia, though very little at the moment, other than BHP's Olympic Dam. And then you have a bit of production coming from Uzbekistan. I'm probably missing a couple, but those are the main ones. And so those producers are clearly making some form of profit on their production, but how much uranium is going to be produced this year? They're estimating somewhere around 130 to 135 million pounds of uranium during a year in which there will be close to 180 million pounds consumed. So that is a 45 million pound, roughly, primary production shortfall. And when it comes to the actual amount of demand burned through in nuclear reactors this year in U308 equivalent. Now, of course, we have a bit of secondary supply, but that situation is in huge flux. So what is this incentive price that we were talking about? This is a price that when we acknowledge that we are in a supply shortfall, we acknowledge that the demand for uranium not only is relatively static, even in recessionary times, but is set to grow over the next few years out into the end of the decade and beyond. We're talking about, a 2%, maybe up to 3% growth, depending on the year, depending on how many reactor restarts in Japan, depending on how many new reactors hit the grid. But either way, it's growing, and that demand is relatively static even during times of recession like we are seeing right now, and we are likely to see more of in the short term. So this incentive price is essentially saying we acknowledge that this supply shortfall exists and only gets worse out in the future. Now we have McArthur River and Paladin's Langer Heinrich set to be back into close to full production over the next, let's say, 18 to 24 months. That helps to get us to a balanced market if you take a snapshot of the market in a given period of time during, let's say, 2024. But as you continue past that point, that supply deficit continues to again grow. What does that mean? That means we need new production to come online to balance that. And that new production is going to have a certain price of uranium locked in, either in long-term contracts, or if it's a smaller producer, maybe they can sell into the spot market, sell at the spot, but they will need a certain price in order for that to happen. Now, there's some ISR development projects in the United States that have cost profiles, let's say in the 40s, $40 a pound range. But mostly these larger projects that really move the needle need much larger and much higher uranium prices. Now we're seeing the cost of capital go up. We're seeing the cost of diesel fuel go up. We're seeing the cost of labor go up. All of these things are rising. And so when you consider the CapEx needed to bring on, let's say, Global Atomic's Dasa mine in Niger, Bannerman's Etango mine in Namibia, we're talking about much higher prices. Now, Global Atomic needs a lower price because they have higher grades, but Bannerman's Etango is a lower grade, very large project, hundreds of millions of pounds. They do need a higher price. So that incentive price, this thesis has been bandied about for a lot of years, right? When we saw the uranium long thesis really start to gain steam in the late 2010s, that incentive price was $60 to $65 a pound. That incentive price right now is probably closer to $80 to $90 a pound, if not more. And things seem to only be getting worse in terms of supply chains, in terms of inflation. So these prices need to be much higher. And now we're sitting at $47.50 a pound uranium. That needs to double. That needs to double minimum in order to get us anywhere close to where we need to be to really incentivize projects to come online to support this nuclear renaissance that we're actually seeing in the energy markets globally. So what does that mean? Just to wrap that all up, basically the incentive price needs to be much higher to bring new mines on stream, new production online in a market that already has a large deficit. This is only going to exacerbate the supply shortage if lower prices persist. Now, do I believe they are going to persist? No, I do not. We're already seeing all of the elements of the fuel cycle in a clear uptrend, and that is only going to continue. even with a recession approaching or possibly already here, we're seeing the housing market come to a screeching halt. We're seeing a very, very tumultuous and fragile energy situation for Europe as we halfway through the year and into the summer months. We've got a very short number of months to hopefully fix that situation, or at least bring some more of the reactors that are currently in maintenance outages in France back online. Hopefully Germany decides to keep the remaining 3 reactors online. 2 of the 3 they just shut down in December could easily be restarted. Will they do that? Probably not. But either way, we're looking at a situation where the uranium price is likely to remain strong and in an uptrend, even though we are in a risk-off environment across equities and markets. And we're seeing recessionary markers in the economy. With all of that said, I want to leave you guys with a couple of quotes, okay? The first quote is from Rick Rule, and this I retweeted a couple of days ago because I thought it was very, very simple and very apropos, okay? So Rick says, you do what's easiest. If there's no buyers, so it's easy to buy the stock, you buy some. If there's no sellers, so it's easy to sell the stock, you sell some. Whatever the market makes easy for you to do, you do. I loved that quote. I loved that quote so much. Right now, it is very easy to buy. The sellers are in control here, okay? The sellers definitely have more motivation here. And on that note, I'm going to leave you with another quote. And I've read from this book before. I'm going to do it again. The Most Important Thing by Howard Marks, probably my favorite investing book. This is chapter 9. I'm not going to read the whole chapter. Awareness of the pendulum. The most important thing is awareness of the pendulum. Just a couple of quick excerpts from this because I think that we're at one extreme of that pendulum swing right now, okay? When things are going well and prices are high, investors rush to buy, forgetting all prudence. When there's chaos all around and assets are on the bargain counter, they lose all willingness to bear risk and rush to sell, and it will ever be so. Where are we right now in that pendulum swing? Thinking about that quote. One more from Howard Marks, same chapter. When investors in general are too risk tolerant, security prices can embody more risk than they do return. When investors are too risk averse, prices can offer more return than risk. So what I like to do in the cycles of this market in particular, and in markets in general, is not concern myself with selling the perfect top or buying the perfect bottom. What I prefer to try to assess is the risk versus reward at any given time in that pendulum swing. So if I'm looking at, let's say, a stock like NextGen right now, okay? NextGen is trading on the US market, $3.59 at close today, okay? 2 short months ago, it was over $6, the high print, $6.55. That's a 45% discount for the largest high grade deposit of any metal on the planet. This one day will be in mind, and I'm not trying to shill NextGen here at all. I'm pointing out, I'm looking at this, I'm seeing very strong positive divergence in the RSI. I'm seeing NextGen traded at a level that we saw back in February of 2021, okay? That's how cheap this stock, that's how cheap most of these stocks are right now. What has happened since February 2021, okay? Could NextGen fall some more? Absolutely. If risk goes way off in the markets in the next month or two, which it certainly could, we could see another fall. But I'm looking at this right now and I'm thinking to myself, am I willing to make a bet on something? Let's just use NextGen, for example, 359. Could it fall another 10 to 20%? Yes. What is the upside here? If there's a 20% downside, what is the upside at NextGen trading at 359? I would say, considering my understanding of the fundamentals of this industry and of this investment setup right now and where I expect prices to be, equities flows to be, even 12 months from now, this is an easy double with a 20% downside risk. And that's a paper loss at 20%. And I'm just throwing 20% out there. I don't really know how much lower it could go. Things generally can always go lower than you think they can, go much higher than you think they will. And that's certainly the case for uranium. So looking at this, would I be willing to take a paper loss of another 10 to 20% on, let's say, if I added an average in on this stock? Absolutely. If I know that the upside is considerably higher, that's something, that's a risk reward that I like. And you should think inversely when the market is euphoric, when we're trading at, when we're trading far above, let's say, the 200-day moving average. When we're trading at 1.5 to 2 times the 200-day moving day average, that's where I start to kind of look and see, are there other markers that we're getting overbought? What is the risk reward here? It doesn't make sense to trim. Doesn't make sense to sell. For me, it's not going to make sense to sell outright until we are at much, much higher uranium price. And this is, I'm in this for the long term. I can be a very patient, very calm fundamental investor. Not everybody can be. So you have to look internally as well at yourself and what you're willing to tolerate. What kind of volatility can you handle? What sort of risk reward are you willing to place yourself in terms of an investment? But all I can say right now is that aside from myself, aside from the people that I work with directly, my business partners, aside from the people, let's say in my direct circles, the really, really smart people in the room right now are getting very greedy and aggressively adding. So that's for what it's worth. That's not me telling you to buy. It's not me telling you to sell. I'm not your financial advisor. This is not financial advice. But I think the Howard Marks quote about the pendulum is really important, that it will always be that way. When investors are getting out and trying to take some risk off the table, typically there's more reward on the table than there is risk at that point in time. We're seeing these fear and greed indexes at extreme bearish levels right now, extreme bearish. Again, does that mean it can't go lower? Absolutely not. But the pendulum is likely further to one side than it is to another. And which side is that right now? Well, I'll let you decide. All right, I'm gonna leave you all with that. I'm gonna get off my soapbox here. I will see you again tomorrow, and I hope that you have a great night. Cheers.